At the end of the day, whether it's mutual funds or ETFs, what really matters is that you're saving and not making stupid decisions with your money.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Darryl Lyons.
Hey, this is Darryl Lyons, CEO and co-founder of Pax Financial Group, and you're listening to Retire in Texas. This information is general in nature. It's not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. So the last show I talked about stocks and bonds and the differences, and then this show, this may seem very remedial to you, but I think it's important that you reflect on the stocks bonds thing. Make sure that there's no misconceptions on how those things behave in a client's portfolio. I'm more inclined to own stocks because I think owning companies is a good idea. To have ownership in a company, whether you're a small business owner or if you're not a small business owner, to be able to access the markets and access to be an owner of a company is, to me, absolutely amazing. And I've had to reflect on this a lot over the years because I just think this idea of being able to participate in ownership of companies is absolutely 100% understated. Because think about it, if 100 years ago, 200 years ago, maybe even 1,000 years ago to make it real, my family might have been a serf or peasant. How are you going to get out of this thing? Like, I'm not going to, in that situation, if I were that, I can't go out and just go buy land to get rich or, not likely going to marry rich. So what happens to these serfs and peasants over the years? That's who they become the rest of their lives. And so there's a lot of ways to break through that in America. And one way that's often discounting is by being able to own companies through the stock market, through the capital markets. It's absolutely I wish I could sit down with you kneecap to kneecap on a couch and just explain how powerful this is. But so in the last podcast, I just shared that dynamic with you and made sure that you understood how stocks work relative to bonds. This one is like 2.0 because I really want to make sure you understand how mutual funds work relative to exchange traded funds. And this is important because sometimes just a slight misunderstanding here can really throw off your game plan. Making assumptions, and I tell you, I'm the worst. I am absolutely the worst, where I assume somebody knows something that they don't. I promise you, I just do this all the time, and I've really worked on this. And so the last podcast is just breaking down those assumptions and making sure that you clearly know the difference between a stock and a bond and how they behave. This one, I want to talk about the difference between mutual funds and exchange traded funds, which there are misconceptions here as well. So what's a mutual fund? So a mutual fund is a mutually funded account with thousands of people across the country where there's a manager, let's say in New York, with a suit and a bunch of computers, and he's responsible, and I'm saying he is responsible for buying and selling stocks on your behalf and all these other people around the country. That's a traditional mutual fund. They started in 1924, so they've been around a while, good track record. And they allow people to not just own one company, not just own Microsoft or AT&T or Disney. If you've looked at Disney's performance the last 5 years or so, you'd be disappointed. You wouldn't have really met your objectives. But if you would have put your money in a mutual fund where it's spread out, maybe you own some NVIDIA or something, collectively, you're going to be okay. It's like, I guess, think about Enron. Like, you don't just own Enron. Imagine if you just put all your chips on Enron. And I know, by the way, I've known people over the years that just bet on their company just because they had a probable cause. I don't want to say cause. An expectation that was just rooted in facts, but they were missing some pieces of information that they didn't know, and they lost it all. I've seen that before, betting it all on one company. I have seen that over my career since 1999. I love owning stocks. I think owning pieces of companies are awesome. The mutual fund in 1924, when that came out, that changed the game because now we're not betting on all one company. spread it out between, I've seen as low as maybe 20 stocks in a mutual fund. That's probably about right, to, I'm guessing maybe 2,000. That may be on the high side. I've seen thousands of mutual funds, and there are thousands. And in 1924, there weren't that many, and over the years, because it's become such a big business, that there are a lot more. Again, mutual funds work great. We're going to talk about how they differ from exchange traded funds, but just some of the other features of mutual funds. Again, you mutually fund an account with thousands of people across the country, a guy in New York or Chicago, or a lady in San Antonio for that matter. There's a couple in San Antonio. I think US Global is one I can think of. Frost Bank has mutual funds. So those are a couple institutions, not a lot in San Antonio, but there's an actual person responsible for buying and trading stocks. And I get to, as an advisor, I get to meet these people. So I get to sit down with them, sometimes in my office, or many times I have to travel to Boston, Chicago, LA, New York, and meet with them, and just to see the character of who they are. They're all smart. There's no doubt they're all smart. It's just trying to understand when I'm meeting with them that there's an alignment between the objectives and a little bit of character judgment in a short amount of time. But a mutual fund is a person, and that's part of the point I'm trying to make, because a mutual fund is a person that's responsible for buying and selling, and that person is human, and they make huge human judgment calls. And so they will do a ton of research on a company, and sometimes they do so deep of research that it's exciting for me. Like, they will tell me that a CEO of XYZ company is about to retire in 2 years, so you don't want to own that stock right now. Like, that stuff's hard to find on computers, and that's just from them having conversations. Speaking of Enron, American funds decided not to invest in Enron. They were coming back on a plane from meeting with them. I think I was out of Houston, and their notes, their analyst notes, an analyst is like they work for the fund manager. And their analyst note said, won't invest, won't shoot me straight, concerned about the integrity of the leadership. That's what a mutual fund does, is it screens out companies that might be problematic. The price of a mutual fund, this is just worth noting. You don't know the price of the mutual fund until the close of the business date. And then they do all the calculations to say, this is the price, this is the value of that mutual fund. There are some minimums on mutual funds, and they're not too high, but maybe 5,000, sometimes 10,000. And mutual funds, just like exchange traded funds, will pay out dividends. The dividend rates, if you've seen over the years, have gone down considerably. There's still plenty of companies that pay dividends, but not like they used to. One of the biggest things that I've been challenged with as an advisor that I've actually had clients upset with me for, and I get it, is capital gains. So you can pay taxes on mutual funds. You can literally pay taxes on mutual funds where you didn't make any money. It is absolutely the craziest game, and very sensitive to that today. But there was a period of a decade where the whole industry was frustrated with this. And it really led to the proliferation of exchange traded funds. Probably the capital gains thing, where clients were upset, advisors were upset. And of course, you can't blame the clients for being upset at the advisor for not being able to navigate through this. But the advisor was like, we would call the fund company and go, what are you doing? So I think this capital gains issue, paying taxes on money you didn't make, think about that, paying taxes on money you didn't make. This was happening in the mutual fund industry, was part of the catalyst to the exchange traded funds. Now, exchange traded funds have the same last name, funds. So in essence, they're cousins, right? Is interesting commentary. I was part of that Dave Ramsey network. I actually flew up to Nashville and had some interesting conversation with Dave and his team about the proliferation of exchange traded funds and how they are an important tool for clients on a go-forward basis. And Dave and his team were very open to the idea of modifying the, I don't want to speak on his behalf, but we were having good conversations about what does it look like in this next iteration of investing for Dave Ramsey to say, okay, Dave is okay with you doing exchange traded funds versus mutual funds. Like, so we were asking ourselves that question. Dave, by the way, I love Dave as a person and even as just a professional, but he's going to stay with his game. He started with mutual funds and he's going to stick with mutual funds. He had a hard time with exchange traded funds because they're abused. And so he didn't want other people to abuse exchange traded funds. How are they abused? Remember I said mutual funds, the prices of mutual funds are at the end of the day. Exchange traded funds, you can buy and sell throughout the day. So if you freak out during the day, you can click and sell it. Dave Ramsey does not want people to do that, as you would imagine. And people are doing this all the time. Exchange traded funds are cousins to mutual funds. They both have the same last name. The difference in exchange traded funds, there's several differences. The main difference in exchange traded funds is that they're run by typically a computer. So a computer, and I'm using that facetiously, is they will buy a bunch of stocks and they'll leave them alone. They won't go and look at the CEO and say, is the CEO about to retire? They don't do that kind of research. They just say, buy 50 stocks that have low debt, or buy 50 stocks that are growing at a fast pace. And then they buy those for you. It's mutually funded with thousands of people across the country. And then they buy that basket and then they basically leave it alone. They're not buying and selling anymore. They may do modifications to it, but they're just leaving it alone. And the cost, by the way, let's say, and I'm just rounding here, mutual funds have gone down in cost over the years, especially since the 80s. Oh my gosh, I've seen the cost come down considerably. And some of that scales and efficiencies, but a lot of that's the ETFs just putting pressure on them. But mutual funds, let's say they cost 1% internal expense ratio. You don't even see this, by the way. It's in the fund. Their equivalent exchange traded fund might cost 0.1%. And by the way, that adds up over time. So exchange traded funds are considerably lower than mutual funds. That's why if you look at trend charts, the exchange traded funds are trending way more rapidly than mutual funds, like not even close. But exchange traded funds, the low cost is really, really the advantage. And then some people, even institutions, are using them to buy and sell throughout the day. When you hear of an index, you've heard this thousands of times before. Own the S&P 500 index and call it a day. An index is like an exchange traded fund. It's like almost, you can use those names almost synonymously. And you can buy an exchange traded fund that owns the S&P 500 index, very low cost. And it'll own 500, the S&P 500, it'll own 500, I actually think it's 498, but 500 companies, and leave them alone and just let them do their thing. And you can buy that for an extremely low cost. So a lot of people love buying the S&P 500 index. And they would prefer doing that. Many people, Warren Buffett being one of them, that's just as an example, would prefer buying an index, the S&P 500 index, maybe as an ETF versus owning a mutual fund with the person in New York who might charge more. And here's the kicker. The majority of mutual fund managers with their suits in Chicago, wherever, the majority of them don't even do better. They do worse. The majority of them do worse than their index or equivalent exchange traded fund index. Hope that didn't confuse you. You may have to do some research, a little bit more research if that does throw you off. But a mutual fund will typically underperform an exchange traded fund that's just owning the index at a very low cost. That's passive. That's a key descriptive word. It's passive. It's not buying and selling all the time versus a mutual fund, buying and selling all the time, charging more in fees, but not performing as well. So that's another catalyst for exchange traded funds, is not only that capital gain thing that was frustrating everyone, but the low cost and then the outperformance of exchange traded funds. Then it gets really weird because, I do research just like we all do. And I love Morningstar. That's one of my favorite places to go to for fun research. So if you want to dig into this more, go to Morningstar. Tons of research, articles, awesome stuff. Love it. Out of Chicago, they're publicly traded. But here's where it gets really nuanced. And I think an advisor can be very helpful here. Some areas of the market, it's a no-brainer. Like large companies. If you want to own large companies, the S&P 500 is pretty darn good versus a mutual fund. They're just not outperforming. But here, it does get nuanced. Like, for example, I was looking at bond funds, and I'll put this research so you can have it. In bond funds, specifically, we're looking at PIMCO, not suggesting you buy PIMCO, using them as an example. 79% of their funds have actually outperformed after fees their passive counterpart. So when the rhetoric in the marketplace is that most mutual funds don't do as good as ETFs, there are some pockets. like maybe emerging markets, maybe bonds, that you might be better off getting a manager who can sometimes sniff out bad CEOs. Sometimes they can make good judgment calls on currency. Sometimes they can find companies that are maybe rated BBB because of some balance sheet issues, but they find they're a better company than is expressed in the marketplace. They can sniff out stuff. So there are some areas where mutual funds can do better, and so an advisor can work with a client to figure this out. Okay, I know I've covered a lot, but let me make sure I make this last point. Sometimes people say, they say, what do you invest in? Well, I invest in a 401k. You don't invest in a 401k. You invest in mutual funds or exchange traded funds inside of a 401k. Your 401k is just a wrapper. It's a section of the code called a 401k subsection K. It's just a wrapper on the investments inside, right? And so you don't invest in a 401k. You don't invest in a Roth IRA. You don't invest in an IRA. You invest in funds. You should. Sometimes stocks, sometimes bonds, but you typically invest in funds that are inside of that wrapper 401k. That 401k, Roth IRA, traditional IRA, that's just a description to the IRS of how your money should and will eventually be taxed. So that's the difference between mutual funds and exchange traded funds. I'd be happy to do part 2 if there's some emails that come my way that say, hey, could you double click onto this area because it was confusing. But I covered a lot of ground that's certainly subject to a ton of research and academic thought, white papers. If you want to do more digging, like I said, Morningstar is a good place to go. At the end of the day, I guess that's always a good thing to say. Somebody told me at the end of the day, it's still the end of the day. At the end of the day, whether it's mutual funds or ETFs, what really matters is that you're saving and not making stupid decisions with your money. That's really what it boils down to, is just what we are collectively doing. If we wake up one day and say, man, I should have done ETFs or I should have done mutual funds, there's definitely some advantages in working with your advisor on figuring that stuff out. But the main thing is that you're saving 15% of your gross income, and that in terms of your retirement accounts, you're not messing with it too much. I think that's the main point. That's the one that you can control. Again, email me, Darryl@paxfg.com for further discussion. And remember, you think different when you think long-term. Have a great day.